Welcome to PIMCO Pod. In this episode, we discuss how in the Warsh Fed's new era of two-way risk, bonds offer something rare, potential downside risk mitigation that investors get paid to hold. Stay tuned after the conclusion of the podcast for additional important information. Old-Fashioned Bond Math for a New-Fashioned Fed by Mark Seidner and Pramod Dewan. Every so often, markets present an opportunity to reset the muscle memory of a generation of investors. The arrival of a new U.S. Federal Reserve Chair, one who has heralded a genuine changing of the guard, is one such moment. Kevin Warsh's early signals have been clear. Expect less forward policy guidance, lighter use of the Fed's balance sheet, more debate among officials, and a greater willingness to act aggressively, and even to be wrong, in both directions. Expect the Fed to be less reliant on interest rate projections and less inclined to act as a risk manager for financial markets. This change is significant. For the better part of 2 decades, the Fed's implicit job description has included suppressing market volatility, telegraphing intentions, and smoothing the path for risk assets. Investors were rewarded for moving as a herd in accordance with the Fed's dot plot forecasts rather than doing their own analysis. A Warsh Fed appears prepared to let markets stand more on their own, with less explicit guidance or implicit backstop. That stands to increase volatility, dispersion, and two-way risk. Those happen to be the raw materials for active investment managers to pursue enhanced returns. And those raw materials are especially beneficial at a time when basic bond math is already working in investors' favor again. Exercising the ghosts of 2022. Amid an era of relentless stock market gains, the renewed case for fixed income has been overshadowed, especially after the Fed's post-COVID policy path produced some rough patches for bonds. In 2022, fixed income faltered as the Fed hiked rates sharply to combat an inflation spike. Bonds have endured a repricing of the front end of the yield curve, a sell-off at the long end, a testing of the duration diversifies narrative, and a steady drift of financial advisors toward equity risk. And yet, bonds have quietly gone back to work. This year, even with the 10-year Treasury yield above where it began 2026, high-quality bonds have done their job, posting positive total returns and outperforming cash across most segments of the curve. Meanwhile, disinflationary forces are reasserting themselves after the energy price shock triggered by the conflict in Iran. Real, inflation-adjusted yields sit near multi-decade highs that not only reward investors, but also give policymakers ample room to move in either direction as the data dictate. The Fed's institutional independence and credibility on inflation are no longer in doubt. Still, the muscle memory of recent years has kept many allocators from noticing the merits of fixed income. Now, it's time to revisit those merits. The math. The 10-year Treasury note today yields about 4.5%, roughly 4 percentage points above the all-time lows seen in 2020. Historically, starting yields have been highly correlated with 5-year forward returns. That suggests a solid baseline for returns in a steady-state economy. Now imagine the next genuine growth scare, credit event, or geopolitical shock. In that scenario, our baseline view is that central banks would cut rates significantly. If the 10-year yield fell to, say, 2%, the total return on that bond could approach 20% over the following year. That means that in the adverse economic scenario, the case where equity investors most need help, a high-quality government bond position could plausibly deliver a double-digit offset, and investors are being paid a starting yield of about 4.5%, simply to wait for that optionality to matter. Our baseline view is that the Fed will hold its policy rate steady through the rest of 2026, and that the next move is more likely to be a cut than a hike. But the beauty of bonds today is that performance isn't predicated on a single macro outcome. Across a range of growth and inflation outcomes, soft landing, no landing, recession, and stagflation, high-quality bonds could deliver positive total returns, including meaningful upside in the scenario that matters most to a balanced portfolio. Even if rates were to rise, today's yields offer a significant income cushion to offset price losses. This is convexity in plain English, a truncated downside and a meaningful upside. The case for bonds, not the case against equities. Equity valuations remain historically elevated, a concern we hear in client conversations. But valuations have been stretched for a while, and stocks have kept climbing. Rather than trying to forecast an equity downturn, the more useful observation is that you don't need a bearish view on stocks to justify owning bonds. Instead, the case for fixed income rests on standalone bond math, starting yields that compound, convexity that protects, attractive global yields that diversify. For more, see our June 24th publication, Global Bond Diversification, Higher Yields and New Opportunities for Alpha, and a More Laissez-Faire Fed. Bonds also look increasingly compelling on a relative basis as diversification has grown scarce elsewhere in portfolios. In equities, the top 10 issuers account for roughly 37% of the S&P 500, concentrating exposure in a handful of mega-cap names. In private direct lending, the fastest-growing corner of many portfolios, roughly 31% of business development company, BDC exposure, sits in software and technology. A high-quality fixed income allocation, by contrast, sources from a genuinely diversified mix of rate, credit spread, and currency exposures across sectors and regions. The Warsh dividend. A generation ago, the Fed reshaped itself in the aftermath of the global financial crisis, laying the groundwork for the investor muscle memory that endures today. Large-scale asset purchases flattened the yield curve, while calendar-driven forward guidance sedated the front end. Dot plots and press conferences trained markets to expect the Fed to telegraph its every move. Passive investing flourished as active decisions migrated to Washington, and bond yields marched toward all-time lows. In a Warsh regime, that machinery is set to recede. For more, see our June 17th macro signposts, hawkish-leaning committee, reform-minded chair, Warsh's first Fed meeting. Volatility will be absorbed by markets rather than managed away, and a Fed that telegraphs less certainty is a Fed that reinvigorates opportunities for active managers, including curve analysis, directional views, currency positioning, and relative value trades. The result is a doubly supportive backdrop in our view. Higher starting yields have brought old-fashioned bond math back in investors' favor, and a Warsh Fed stands to enable active investors to build on that already attractive baseline for returns. Thank you for listening. That was old-fashioned bond math for a new-fashioned Fed. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.